Welcome to our deep dive on the down payment dilemma. Today we'll explore whether you should maximize cash by leveraging your mortgage or eliminate debt to secure peace of mind. We'll compare both approaches, walk through a decision framework, and run sample numbers. By the end, you'll have a clear process to choose the strategy that aligns with your risk tolerance and goals. First, we will define the real decision you need to make. Next, we will confirm a crucial prerequisite, the emergency fund. We will present both the contrarian approach that embraces leverage and the traditional approach that prioritizes debt reduction. Afterward, we will visualize the decision flow, compare the strategies side by side, and run sample numbers. Finally, we will test your understanding with short quizzes and wrap up with clear takeaways. Next, let us clarify the central question. Are you optimizing for higher expected net worth through leverage, or for guaranteed peace of mind by reducing debt? Clarifying this priority will guide every subsequent decision in your home financing strategy. Before we proceed, please note that this content is educational and not financial advice. Your situation may differ due to taxes, interest rates, fees, and personal risk tolerance. Consult a qualified fiduciary advisor who understands your full financial picture before making any decisions. Moving on. Always start by building and maintaining a 6-month emergency fund before considering larger down payments or extra principal payments. Homeownership brings unpredictable costs, such as repairs, insurance changes, and property tax adjustments. Your goal is to avoid becoming house rich and cash poor. Once the emergency fund is secure, the next decision is how much to put beyond the 20% benchmark that typically avoids mortgage insurance. Now, let us consider the contrarian view that embraces leverage. With a conventional 20% down payment, you control a large asset using relatively limited cash, which preserves liquidity. If your expected after-tax investment returns exceed your mortgage interest rate, allocating excess cash to a diversified portfolio may increase long-term net worth. Liquidity also positions you to capture opportunities and handle surprises. However, this approach requires accepting market volatility and maintaining behavioral discipline through ups and downs. It also assumes your cash flow can comfortably support the mortgage, even during economic stress. Meanwhile, the traditional approach prioritizes paying down the mortgage to achieve peace of mind. This reduces lifetime interest costs and risks tied to debt. The effective return on extra principal is the mortgage rate you avoid, which is guaranteed and risk-free from a market perspective. If your mortgage rate is high or market volatility causes anxiety, this method can be the superior choice, even if expected portfolio returns might be higher. Next, use this simple decision flow. First, confirm your 6-month emergency fund. Second, compare your realistic after-tax investment return to your mortgage rate. If the return exceeds the rate, favor using approximately 20% down and investing the excess. If not, favor a larger down payment and prepayments. Regardless of your choice, stress test your monthly cash flow and revisit your psychological comfort. If your tolerance for volatility is low, shift toward debt reduction. If it is high, the leverage path may be suitable. Now, let us compare the two paths. The leverage path uses a lower down payment, at least 20% to avoid mortgage insurance, while preserving liquidity to invest the difference. This can deliver higher net worth if after-tax returns exceed the mortgage rate, but it demands discipline through market volatility and suits those with stable income and higher risk tolerance. The payoff path increases the down payment or accelerates principal reduction. It delivers a guaranteed return equal to interest saved, reduces lifetime interest and debt risk, and can lower anxiety. It is well suited to conservative temperaments or when mortgage rates are relatively high. Continuing, here is a 5-year illustrative snapshot to compare 20% down versus 35% down on a $500,000 home at 6.5% for 30 years. Scenario A uses $100,000 down and leaves $75,000 invested at 5% annually, producing an approximate value of $95,700 after 5 years. The loan payment is about $2,528 per month, and interest paid over 5 years is approximately $126,700. Scenario B uses $175,000 down, with no excess invested, a payment near $2,054 per month, and approximately $103,100 of interest over 5 years. The difference suggests the larger down payment saves around $23,600 in interest over 5 years, while the invested difference could grow to about $95,700. These figures are approximate and exclude taxes, insurance, closing costs, potential mortgage insurance, and tax effects. They are for demonstration only. After that, run your personal numbers. First, list your assumptions, including the property price, interest rate, term, taxes and insurance, and liquid cash on hand. Second, confirm that your 6-month emergency fund remains untouchable. Third, calculate monthly payments at different down payment levels. Fourth, estimate a realistic after-tax investment return range, such as 3 to 7%, and compare that to your mortgage rate. Fifth, project 5 to 10-year outcomes for both paths. Sixth, stress test job stability, market declines, and potential expense spikes. Finally, decide using both the math and your psychology. Quiz time. The question is, what should you prioritize before making extra mortgage payments or increasing your down payment beyond 20%? Option A, building a 6-month emergency fund. Option B, maximizing retirement contributions first. Option C, buying points to lower the rate. Option D, choosing a 15-year term. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is A, building a 6-month emergency fund. This protects cash flow, reduces the chance of needing high-cost debt for emergencies, and prevents becoming house-rich and cash-poor. Here is the second question. If your realistic after-tax investment return is higher than your mortgage rate and you are comfortable with volatility, which approach is generally favored? Option A, maximize down payment and prepay principal. Option B, use approximately 20% down and invest the excess. Option C, choose an adjustable rate mortgage. Option D, avoid owning a home entirely. You may pause the video now to think about the answer. We will discuss the answer in the next section. The correct answer is B. When expected after-tax returns exceed the mortgage rate and you accept market volatility, the leverage path, using roughly 20% down and investing the surplus, is generally favored. Furthermore, consider these professional tips and common traps. First, run a tax reality check by modeling after-tax investment returns and any mortgage interest deduction. Second, analyze private mortgage insurance carefully and avoid it if you can, or weigh its cost against the time it takes to reach 20% equity. Third, protect liquidity by keeping your emergency fund untouched and ensuring that investment cash is accessible. Fourth, recognize that behavior often beats spreadsheets. If financial stress harms your sleep or decision-making, choose the calmer path. Additionally, here is a concise checklist in Markdown format. First, define whether you aim to maximize growth or maximize certainty. Second, verify that your 6-month emergency fund is intact. Third, compare your after-tax investment return to your mortgage rate. Fourth, stress test cash flow with higher expense assumptions. Fifth, choose a path and automate either your investing or your principal prepayments. Finally, review annually and adjust as your life circumstances change. To summarize key takeaways, always prioritize the emergency fund. If your after-tax returns are likely to exceed your mortgage rate and you remain calm through volatility, leaning toward leverage can make sense. If your mortgage rate is high or market stress weighs on you, the payoff path may be better. You can also begin with a 20% down payment and add principal prepayments later as cash becomes available. Above all, align the choice with your own psychology rather than external rules of thumb. In closing, there is no universal right answer. The right choice is the one that fits your goals, cash flow, and temperament. Run the math, honor your mindset, and reassess each year as interest rates, markets, and life circumstances evolve. Thanks for watching. If you found this helpful, please like the video, share it with someone making this decision, and subscribe for more evidence-based personal finance content. Finally, tell us in the comments whether you are team leverage or team payoff, and why.